Cipher Mining, ticker CIFR, just wrapped up a volatile week. After a string of record highs and analyst upgrades, the stock closed Friday at $20.69, down about 4.7% on the session. That decline capped off what was otherwise one of Cipher's most pivotal weeks in company history, a week where it officially transitioned from being viewed as a crypto miner to being taken seriously as an AI infrastructure play. So why did the stock slide on Friday? And is this a warning sign or a potential buying opportunity? Let's break down what's happening, the news, the market forces, and what investors should be watching heading into next week. First, let's set the scene. Earlier in the week, Cipher's stock soared to an all-time high of $25.52, closing midweek around $24.71, up nearly 10% that day. The catalyst was massive, a 15-year, $5.5 billion lease agreement with Amazon Web Services, giving AWS up to 300 megawatts of capacity for AI and high-performance computing workloads. This deal signaled Cipher's official leap into the world of AI-driven data center infrastructure. It meant long-term contracted revenue. It meant diversification beyond crypto mining. And it meant that a company once tied to Bitcoin prices was now inking multi-billion-dollar partnerships with cloud computing giants. Investors loved it. Analysts loved it. Needham & Company even raised their price target from $15 to $26 and reiterated a buy rating. For a moment, Cipher looked unstoppable. But then, Friday hit, and the stock fell 4.7%. Now, this wasn't because the AWS deal suddenly lost value or because Cipher announced bad news. The drop had far more to do with macro forces than company fundamentals. The entire NASDAQ composite, where Cipher trades, was down sharply for the week. Inflation fears resurfaced. Trade war rhetoric picked up again. Investors began rotating out of high-beta, high-growth names, exactly the kind of stocks that had been leading the rally. So even though Cipher's story remained strong, it was swept up in a broader risk-off move that punished most tech-adjacent growth stocks. Put simply, Cipher got caught in the downdraft. Now, there's another layer here that's worth noting. Earlier in the week, Cipher also announced the pricing of $1.4 billion in senior secured notes, a debt offering intended to fund construction of its massive Barber Lake facility in Texas. That's the facility tied to the AWS lease. While the debt financing is a necessary step to build that site and expand the business, markets can be fickle when it comes to leverage, especially when inflation and interest rate worries dominate the headlines. So even though this debt will fund income-generating infrastructure, some traders likely saw the words $1.4 billion in new debt and hit the sell button. It's a classic short-term overreaction, and one that could create opportunity for long-term investors who actually understand the company's roadmap. So let's zoom in on that roadmap, because this is where Cipher's story gets really interesting. The AWS deal isn't happening in isolation. Cipher already had hosting partnerships with Google and FluidStack, supporting AI and high-performance computing workloads at other sites. In its latest quarterly update, the company reported $72 million in revenue, $41 million in adjusted earnings, and only a $3 million net loss, a huge improvement compared to the crypto bear market days. The company also reaffirmed progress on two cornerstone projects. The Barber Lake facility, now being financed by the new notes, and the Colchis site in West Texas, a 1-gigawatt project that could make Cipher one of the largest independent AI infrastructure providers in North America. Together, these sites could redefine Cipher's identity from Bitcoin miner to AI power infrastructure developer. That's the real transformation taking place here. But here's what separates Cipher from other names in the AI data center space. They already own the hard assets. They already operate in regions with abundant power, renewable energy integration, and scalable land footprints. And they already know how to manage massive power loads, something they perfected during their years in Bitcoin mining. That means they're not starting from scratch. They're repurposing their existing energy expertise for a new, booming industry that desperately needs what they provide: power, cooling, and secure, low-cost hosting. It's actually a brilliant evolution. So if the fundamentals are improving and the long-term story is so strong, what should investors really take away from this pullback? The short answer: context. Cipher's 4.7% decline came after a week of huge gains, nearly 10% on Wednesday alone. After a move like that, some profit-taking is perfectly normal. Add in a rough week for the NASDAQ, rising bond yields, and the chatter around trade tensions, and you get the perfect recipe for a short-term dip, even in strong names. The long-term thesis hasn't changed. If anything, it's been validated. But volatility is the price of admission in early-stage transformation stories. Now, it's worth talking about the risks here, because investors deserve the full picture. First, execution risk. The AWS lease begins in August 2026. That gives Cipher a long runway to build, test, and deliver. But the market is already pricing in success. Any delay, cost overrun, or operational setback could hit the stock hard. Second, debt risk. A $1.4 billion note issue is significant for a company of Cipher's size. Even if it's used wisely, it introduces leverage and interest obligations that the company must manage carefully. Third, valuation risk. After running from the mid-teens to above $25 in just a few weeks, the stock was arguably stretched. MarketBeat's consensus price target sits around $23.77, not far from where it closed this week. So while the upside story is exciting, investors should expect volatility and, at times, sharp pullbacks like this one. Finally, macro risk. Cipher's fate, like many growth names, is partly tied to broader market conditions, inflation, rates, and tech sector sentiment. A risk-off environment can drag it down regardless of fundamentals. Still, the broader structural trend here is too big to ignore. AI is fueling an unprecedented demand for power and compute. Hyperscalers like Amazon, Microsoft, and Google are pouring billions into building and leasing data center capacity. And companies like Cipher, with energy-dense assets and construction capability, are perfectly positioned to serve that need. It's a bit like the gold rush analogy. Everyone's chasing the gold of AI models, but Cipher is selling the shovels, in this case, the electricity and space those models need to run. That's a powerful long-term business model, provided they execute. Now, here's something worth watching in the near term. Cipher will be participating in 2 investor conferences next week, the Cantor Crypto and AI Infrastructure Conference on November 11th and the JP Morgan US Opportunities Forum on November the 12th and 13th. These events could generate new headlines, investor questions, and potentially even additional partnerships. If management provides fresh detail on project timelines or financial outlooks, it could easily swing sentiment again, possibly turning this dip into a rebound. So for anyone following the stock closely, keep an eye out for updates from those events. Let's take a moment to reflect on the psychology here, because it matters. When a company transitions from a high volatility sector like crypto into something as capital intensive as AI infrastructure, investors' expectations change. They start caring less about speculation and more about execution. And that's where Cipher is right now, in the in-between stage. The hype cycle is cooling slightly, but the delivery phase is just beginning. If they execute, this could be a textbook case of a speculative company becoming a real business with recurring revenue and long-term contracts. That's the kind of shift that can redefine valuation multiples entirely. So, how should investors think about this moment? If you're long-term bullish on AI infrastructure and believe Cipher can deliver on its contracts, then this pullback is not a red flag, it's an entry point. If you're short-term focused or nervous about macro headwinds, it may be better to wait for confirmation, perhaps a bounce off technical support or fresh guidance at the investor conferences. Either way, the key is understanding what stage this company is in. The growth story is still intact. The fundamentals are improving. And the macro headwinds that caused this week's dip will eventually pass. What matters most now is execution and delivery. As we head into the weekend, the takeaway is simple. Cipher Mining just had its most transformational week ever, and despite the pullback, it remains one of the most interesting mid-cap plays in the AI infrastructure space. Yes, there's volatility. Yes, there's debt. Yes, there are macro risks. But there's also a clear strategic pivot backed by Amazon Web Services, Google, and FluidStack, partnerships that most companies of this size could only dream of. So while some traders see Friday's red candle as a warning sign, long-term investors might see it as the start of the next accumulation phase. Final thought. Markets reward execution, not announcements. Cipher has already made the announcements, now it has to prove it can deliver. If it does, this week's $20 price could look cheap in hindsight. And if it stumbles, it will serve as a reminder that in the AI era, even great stories require great follow-through. Either way, this is one company worth keeping on your radar. If you found this breakdown helpful, don't forget to hit like and subscribe. Next week, I'll be covering the key takeaways from Cipher's investor appearances and what they might mean for future price action. Until then, stay sharp, stay focused, and invest with conviction.